Hello everyone, this is Osama Rizvi and welcome to another episode of Monday Macro View. Today I'm going to talk about three different things. First of all, I would like that we talk a little bit about the La Nina triple dip effect. It's purely a weather phenomenon, but it's really interesting that how this effect is going to impact the global financial markets and how it is highly relevant to what is happening in the world right now, especially in terms of the global economy. After that, I would like to mention a little bit about the oil dynamics. Oil prices are taking wild swings these days due to rising interest rates, due to demand issues, and other things. But I think it's really important that we have a look at where are the oil dynamics headed, especially the fundamental ones. I've been speaking a lot about sentiments. And last but not the least, the US housing market. It is one of the most important economic indicators, and I think the signals coming from this market is not really good. So here it is. This shows how the La Nina affects the global weather systems. In short, what it does is that it changes the wind patterns. Because of the wind patterns, some part of the Pacific Ocean becomes cold while the other becomes warmer than that. Because of it, subsequently, it changes the rain patterns, the rainfalls. So, for instance, Indonesia would be warmer than normal, and this area would be cooler than normal. Some areas can face drought like conditions, like here, like in Africa, and some can face a lot of rain, like Australia, and some can be warm, heat waves and heat strokes. So this is really important, and financial markets really keenly follow this effect. And right now, why is this highly significant? Scientists have recently said that we're going to see what they have called a La Nina triple dip. What that essentially means is that La Nina, this effect, for the first time in 20 years, it is going to happen for the third consecutive year. And when it happens, there would be more rainfalls in certain areas, there would be drought in certain areas, in certain regions. And we are seeing already that Pakistan is facing a lot of flooding. This can affect monsoon patterns, which can affect, for instance, India's gold demand, jewelry demand. And not, I mean, and the most important part is that given the soaring and elevated food prices, and there are protests happening right now in Tunisia as we speak. These are the latest ones in Latin America, other countries as well. So this can really exacerbate that thing. And in the last show, you remember that I shared a report that says that 101 countries face a risk of social unrest. We have been, Mark especially, and I and others have been talking about this on regular basis because this is highly important in terms of policy making, in terms of trading as well. What does that mean? If this effect does not go, you're going to see more instability, which means that the markets are not going to be, they're going to be more, there's going to be more volatility in short. So I thought this was really important. And, as you can see, the chances of it happening throughout the year and the next one as well are still pretty bright, which is unfortunate. And, policymakers are going to face some tough policy choices regarding this. Another news, I thought this was important, very important actually. The Fed unexpectedly, not unexpectedly, sorry, unsurprisingly raised the interest rate by another 75 basis point. I mean, we all expected it. Even though it was priced in, the markets reacted really strongly. The Dow Jones, S&P, I mean, they were, all of the ticker symbols were in red. It was like a bloodbath. The markets are still jittery. The interest rates are going to go up until 4.6%, and there is no reversal in the middle, which essentially means that there was sticky inflation, and the Fed really sort of delayed its policy action, which is creating a lot of other consequences, like the second order thinking of it. And ECB, especially if we go to the European side, it's also going to see some rising inflation, as we'll see. So that was really important. But what this is doing with the oil markets? Oil prices are falling as the dollar index has reached 20 years high. That's really important. The oil demand is being affected, and if you look at the fundamentals, I thought this was really interesting. The Asian oil demand, which includes India and China, it is expected to grow only by 500,000 barrels per day. And most of this is because of China's slowdown. This is happening despite the OPEC Plus has not been able to meet its quota from quite a lot of time. So if this was happening in an environment where there were real supply concerns in the fundamental markets, not in the paper markets, this could have caused a really steep rise in prices, but it didn't happen. What it means is that oil markets aren't as undersupplied as it was being portrayed a few months ago in the paper markets. So, and most of this non-compliance in amongst the OPEC comes from Nigeria's fall in output because there are internal issues, and of course Russia's fall in output, which might go up until 1.9 million barrels, but that is February next year. I thought this was also interesting and showed really how the recessionary fears are setting in. Copper, there was a report by Bloomberg. It's really interesting that they expect the the metal to be in deficit, the supply of this metal to be deficit by 2040. Why? Because right now there isn't enough investments in it. Why? Once again, because people are expecting slower economic growth. But as you can see, that the demand for the metal has been quite robust, and this they expect this to go on. In case of a recession, this is the figure, and in case of no recession, this it's pretty much the same, right? But this goes on to show that the overall market sentiment is really now accepting that there will be a recession. If not, it's not if, it's only when. Finally, housing markets. So the mortgage rates after the Fed interest rate hike reached to 6.5%, which is more than twice than what it was last year, and the highest since 2008. Around 38% of the houses in the US have been sold below their listed prices. There has been a 28% fall in luxury home prices. So that speaks about, that really speaks about what is happening in the mind of a consumer. The recessionary fears are being accepted even by the common man, and you can see the steep rise. This is not really good, not looking good with higher inflation, rising food prices. This is something that is going to eat away at the savings. This shows once again the effect of rising interest rates on hiring, which is going to exacerbate the problem. It's a vicious circle. Low income, low savings, housing market goes further down, and you know what happens. Finally, just to wrap it up, once again, the market sentiment tracker. So from the past 2 weeks, I've been saying that the outlook is bearish. Oil markets ended 5%, 5 to 6% last week as well. And I think, as you can see, this area continues to be populated. Dollar at 20-year level high, oil prices fell 5%. Oil demand to fall by 100,000 barrels. This was by the EIA in their recent short-term oil market report. The interest rates were increased, and oil supply. It's very interesting actually how this narrative has shifted. Oil supply has risen for the third straight month. Once again, to remind, this is despite OPEC not being able to meet its production quota. No doubt that OPEC was wise enough that they were looking at the physical markets and not at the paper markets. So this is it. Mortgage rates. I've told you about recently. There are protests being carried out in Tunisia because of inflation and food shortages. Eurozone inflation hit its highest, 9.1%, which means more trouble, more higher interest rates, and you know the whole story. This is good. The geopolitical risks are there. This is some rhetorical things from China in case of Taiwan, but mostly it's the recessionary side. And I expect, of course, the markets to be bearish, and with an additional chance of a sell-off, because now the bearish sentiment is building. The traders are going to cash in their profits really soon. I believe that, but we'll see what happens. So that's all from my side today. I really appreciate comments and recommendations, and we look forward to hearing back from you. Thank you.